March 9, 2023. Customers pull $42 billion out of one bank in a single day, more than $1 million a second, without a single line forming outside a branch. By closing time, the bank's cash balance is negative. Overnight, another $100 billion queues up to leave. The next morning, Silicon Valley Bank, America's 16th largest, is dead before lunch, killed by the safest assets on Earth. This is the economics of the SVB collapse. Subscribe to Crisis Economics for more. Hold two things as we go. 1. 5 months before this happened, the Nobel Prize in Economics was awarded for explaining exactly what you are about to watch to a name you already know from 2 of our previous episodes. 2. Nothing here was hidden. The risk was written down in official letters 31 times. Remember that number. First, a 30-second truth about every bank on Earth, because the whole story hangs on it. A bank borrows short and lends long. It takes deposits that can leave tonight and turns them into loans and bonds that pay back over years. That mismatch is not a flaw, it is the product. It also means that no bank, however healthy, can survive all of its depositors asking for their money on the same day. Banking runs on the assumption that they never will. Deposit insurance exists to make that assumption true. Keep that in mind and now understand what Silicon Valley Bank was, because it was not a normal bank. Founded in 1983, it grew into the house bank of the startup world. By 2023, it banked roughly half of all venture-backed tech and life science companies in America, plus the venture funds themselves, their partners' mortgages, even their wineries. It wasn't just popular, it was contractual. SVB routinely required startups it lent to keep all their cash at SVB, deliberately concentrating the very deposits that could one day stampede. That specialization was its superpower, and it meant SVB's depositors were not millions of scattered families. They were one tight community, a few thousand companies, funded by the same investors, sitting in the same group chats, capable of moving money with a phone and an opinion. And their balances were enormous. About 94% of SVB's deposits sat above the $250,000 federal insurance cap, the highest share of any big bank in the country. Legally, almost none of that money was guaranteed. Then came the flood. In the zero-rate boom of 2020 and 2021, the same easy money world we visited in our GameStop episode, venture funding went vertical, and startups parked the proceeds at SVB. Deposits tripled in 2 years, from around $60 billion to almost $190 billion. A bank has to put deposits to work, and startups don't borrow much, they already have cash. So SVB made one giant decision. It bought bonds. Over $90 billion of long-dated treasuries and government-backed mortgage securities, yielding about 1.6%, locked away for years. Understand what that is. A colossal bet that interest rates would stay near zero far into the future, placed at the exact top of the zero-rate era. And here is the accounting detail the whole story turns on. SVB filed most of those bonds as held to maturity. Under the rules, losses on such bonds are invisible. They never touch your reported capital as long as you never sell. The risk didn't disappear, it just didn't have to be shown. In 2022, the Federal Reserve delivered the fastest rate hiking campaign in 4 decades, taking rates from 0 toward 5% to fight inflation. Bond math is merciless. When new bonds pay 5, an old bond paying 1.6 is worth perhaps 80 cents on the dollar today. Run the logic once and you own it forever. Nobody will pay you full price for a bond earning 1.6% when the bond store next door sells new ones earning 5. Your bond has to get cheap enough that its buyer ends up earning 5 too. That discount is the loss. Nothing defaulted. The US Treasury always repays at maturity, but at maturity was years away, and a bank's deposits can leave tonight. By late 2022, SVB's paper losses had quietly grown to roughly $15 billion, about the size of its entire capital. On a mark-to-market basis, the 16th largest bank in America was already broke and perfectly legal. During most of that same year, SVB had no chief risk officer at all. The seat sat empty for 8 months.
Its interest rate hedges had been wound down. Federal Reserve supervisors had started warning the bank about exactly this rate risk on the balance sheet as far back as November 2021, in formal letters management failed to resolve. And the tougher supervision that might have forced the issue? In 2018, Washington had raised the threshold for strict big bank rules from $50 billion to $250 billion in assets.
A rollback SVB's own CEO had personally urged Congress to pass. Under the old rules, SVB would have faced hard liquidity requirements and Fed stress tests years earlier. Instead, the bank had lobbied away its own seatbelt. The fuse was lit somewhere else. Through 2022, rising rates choked off venture funding, so startups stopped depositing and started burning, withdrawing cash for payroll month after month. To meet the outflow, on the evening of March 8, 2023, hours after Silvergate, a crypto-focused bank, announced its own wind-down, SVB did two things at once. It sold $21 billion of bonds, crystallizing a $1.8 billion loss that had been invisible until the moment of sale, and it announced an emergency capital raise. To a nervous audience, that combination is not reassurance. It is a flare fired over the bank saying, "We have a hole." By Thursday morning, prominent venture funds, Peter Thiel's Founders Fund among them, were advising their portfolio companies to get out. The advice traveled at group chat speed through the most connected depositor base on the planet. That afternoon, the CEO held a call with top investors and asked everyone to stay calm, and telling a room full of pattern-matching venture capitalists not to panic is, functionally, a fire alarm. There were no lines, no branches, no television footage, just founders between meetings moving eight-figure balances from their phones, while payroll processors that ran on SVB's rails began warning thousands of ordinary employees at unrelated companies that their next paycheck might not arrive. $42 billion left in one day. For scale, the great run on Washington Mutual in 2008, the biggest in American history until that morning, was $16.7 billion, spread over 10 days. SVB's depositors tried to move nearly 3 times that before dinner. The bank ended Thursday with a cash balance of negative $958 million. On Friday morning, with another $100 billion queued, which would have made it 80% of all deposits gone in 48 hours, regulators seized the bank before noon. Bank failures are choreographed for Friday evenings. SVB could not survive until the evening. If watching machinery fail in real time is why you're here, this is what the channel does. Every episode, one subscribe keeps it running. Now the weekend that rewrote a 90-year-old promise. Remember from our Great Depression episode why deposit insurance exists. The FDIC, born in 1933, ended bank runs for small savers by making their deposits safe up to a cap. But SVB's money was almost all above the cap, and thousands of startups faced a Monday payroll they might not meet. Roku alone had nearly $500 million stranded. On Sunday night, with Signature Bank of New York $110 billion in assets collapsing the same day, the Treasury, the Fed, and the FDIC invoked a systemic risk exception. Every deposit at both banks, insured or not, would be paid in full. Note precisely what was and wasn't saved, because it matters. SVB's shareholders were wiped to zero, its bondholders were burned, and its management was fired. This was not 2008's rescue of the institutions. Only the depositors walked away whole. And the Fed unveiled a new lending program with a quietly extraordinary feature. Banks could now borrow against their underwater bonds at face value as if the losses did not exist. The panic still needed a second victim. First Republic, another California lender, full of uninsured deposits, wobbled for weeks, took a $30 billion deposit lifeline from 11 Wall Street giants, and died anyway, seized on May 1 and sold to JP Morgan, which cleaned up the wreckage exactly as it had in 2008. In the same March, Switzerland's 167-year-old Credit Suisse was force-married to UBS in a weekend. Count the toll. 3 of the 4 largest bank failures in American history happened in 8 weeks of 2023, and those 3 banks held more assets than every bank that failed in 2008 combined. Here is the twist, and it is what separates this crisis from every other one in our series. There was no fraud at the center.
No toxic mortgages, no hidden derivatives, no shredded documents. SVB died of the oldest, most textbook risk in banking, borrowing short and lending long, executed with the safest securities on earth, reported legally, in plain sight. Sit with the eeriest part. If depositors had simply never moved, every one of those bonds would have quietly matured at full value. The paper losses would have evaporated with time, and nobody outside a few footnotes would ever have known. The losses only became real because the run made them real, a perfect, self-fulfilling prophecy. The Federal Reserve's own autopsy admitted its supervisors had flagged the risks starting in late 2021, piling up 31 open findings, triple the level of comparable banks, and then watched. Its verdict on the bank itself needed only one word from the schoolroom. This, the Fed's vice chair said, was a textbook case of mismanagement.
The bank CEO had sold $3.6 million of stock 2 weeks before the collapse through a trading plan set up in advance, legal, and unforgettable. Employee bonuses landed hours before the seizure. Yet years later, nobody has gone to prison because there was nothing exotic enough to prosecute. And the Nobel payoff? In October 2022, the Economics Prize went to Douglas Diamond, Philip Dybvig, and Ben Bernanke, the same Bernanke from our Depression and 2008 episodes, for the theory of bank runs. The insight that a run is self-fulfilling, that a solvent-looking bank can be killed by belief alone, and that credible insurance is what stops it. 5 months later, the theory ran its greatest live experiment at smartphone speed. Every part of it held. So what changed forever? Quietly, the meaning of deposit insurance. The cap says $250,000. March 2023 revealed that when regulators are scared enough, the real number is infinity, at least for banks whose failure would embarrass the system. Depositors learned it and behaved accordingly. Hundreds of billions migrated from small banks to giants judged too big to fail, which got bigger again. And SVB was the sickest patient, not a different species. That winter, American banks as a whole were sitting on more than $600 billion of the same invisible paper losses, which is exactly why the Fed's new pretend the losses aren't there lending window mattered. Banks quietly borrowed over $160 billion against those fantasy prices before the program closed. The rescue's roughly $20 billion cost was billed to the banking industry, which passes costs to customers, so no taxpayer money is true only in the narrowest sense. The Fed's pretend the losses aren't their lending program entered the permanent toolkit. And the deepest change is speed. The bank run, an institution that used to take days and require sidewalks, now completes in hours through group chats. Regulators have been redesigning liquidity rules ever since for a world where panic moves at the speed of a push notification. And the FDIC itself floated redrawing the 90-year-old insurance system, with special coverage for the business payroll accounts that nearly detonated that weekend. In 1933, America built a dam against bank runs. In 2023, the water found the one valley the dam was never built to cover, and the state, in one Sunday night, silently extended the dam over everything. Whether that makes the system safer or just teaches the next bank that someone will always catch it is the question this whole series keeps meeting. The crypto collapse that lit Silvergate's fuse, by the way, is its own episode coming soon. Crisis Economics takes these machines apart one at a time. Subscribe so you are here when we open the next one.